The key thing that we're going to talk about is taxes and the tax effects it has on business decisions. I've got several actual case studies for you, but it is so incredibly critical, people, that you understand the tax implications. Now, how can I guarantee a 15% tax even though he's going to receive $100,000 a year for the next 5 years, 2008, 9, 10, 11, 12. You follow me? How are we going to do that? I recommended that they use a negotiable note. If you use a negotiable note this year, and by the way, use this for your deals that you're doing in 2008 because we don't know what's happening next year. If we do it for 2008, then in the 2008 income tax return that person files, which is going to be filed April of 2009, correct? They show on a Schedule D that they've sold goodwill, that their basis was zero. The goodwill shown, because it's a negotiable note, will be $500,000. Capital gains rate is 15%. The taxes they will owe is how much, people? $75,000. Federal, I'm talking. They received $100,000 in 2008. They'll have $25,000 in their pocket. But for the next 4 years, regardless of what the tax law is on capital gains, they will receive $100,000 a year and pay how much in taxes, people? Zero. It's been prepaid. Thank you very much, because it's a negotiable note. What I'd like to do is to give you illustrations on cases on every type of business organization. Now stop and think something of how partnership works. If we form a corporation and you pay $30 for a share of stock and you pay $15 for a share of stock, no, let's make it easy, $20 for a share of stock. So you pay $30 for one share of stock in a corporation and you pay $20 for one share of stock in the corporation. You both own one share of stock. What is in the capital account? What's the total amount in the capital account? The equity section, stock account, if this corporation sells 2 shares of stock, one for $30 and one for $20. $50, correct? Now watch me carefully, nothing up my sleeves. This gentleman paid $30 for his one share of stock. What's his share of stock worth? $25. He's at a dilution in excess of 10% as soon as the share of stock was sold to this young lady. And this young lady owns a share of stock that she paid $20 for. What's it worth? $25. In a corporation, all stock certificates are based on averages. Are you with me on it? Now, change the scenario. I'm talking general partners, general partnership. You contribute $30 to the partnership. She contributes $20 to the partnership. What's in the total equity account, people? $50. What's in his capital account? $30. What's in her capital account? $20. A partnership does not work on averages. A partnership, each partner has its individual account. You know, I'm the type of guy when a government senator's office calls and says, we're thinking about simplifying the tax law. I says, no, don't do that. I want it as complicated as possible, as few people understand it, and I want to change it every couple of years. Think about it for a second. But if you don't know the tax ramifications of a transaction, keep this in mind. Every example I'm giving you is an actual case study involved in. Here's what I want you to do. Whenever you deal with a subchapter S corporation, the first thing I want you to do is ask for a tax return. When you get a tax return, don't look at the front page. Don't look at the second page. Go to the 4th page on the tax return. Page 4, and by the way, the number of the tax return is a 1120S. 1120S. Get their tax return. Look at page 4. Look at the bottom of page 4. There's about 3 inches of a little section, and the section is called Accumulated Adjustments Account. You got it? It is the most important thing in a subchapter S corporation when they're going to sell the business. If you remember anything from today's program, remember this one thought. There is a one-to-one relationship between the P&L statement and the balance sheet. If you lower equipment on the balance sheet, you write it off, it lowers your profit. If you put something on the balance sheet, it raises your profit. It's a direct one-to-one relationship. If you have a client that has more inventory on his books than he really has because he's not writing it off, that means his books are too high and his profit's been too high. Typically, however, we find that a business has inventory that's not on his books. You open up a warehouse and say, oh, I forgot to count all those. Well, you know why he forgot to count them or she forgot to count them? Because if they're not in the ending inventory, where do they end up, people? On the cost of goods sold, which what? Lowers the inventory on the books and lowers the profit on the company. Studies have shown that the smaller the company, the more important taxes are to business decisions. You get a $50 million corporation, they're concerned with taxes, don't get me wrong, but if they can save $200,000 or $2,000 in taxes, not going to worry about them. But you get a $1 million deal, $2,000 in taxes, going to kill the deal. So be aware that the smaller the company, the more important taxes become in decision making. And be aware the relationship between the balance sheet and the income statement, the one-to-one relationship, and also be aware that the objective of a privately held company is to do what? Make money but not report